Okay, in this video we'll talk about computing and evaluating direct material variances, and I'll also do direct labor variances, and we'll talk about some of the advantages and disadvantages of using standard costs. So you want to have in your head that put your actual cost over here on the left and your flexible budget over here on the right. Okay, and we can take those, and now notice we're just talking about flexible budget here, and we're dividing that up between price variance and quantity variance. So the total flexible budget variance here is the total of the two. It's the combination of two things, okay, price variance and quantity variance. Either we paid a different amount for whatever we bought, per pound or whatever, or we used more or less than we planned to use. Now here is direct material variances, and this is actually a pretty important slide. There's some things here to notice. I've got actual cost times actual price. This is my total actual here, all right, and there's actual quantity times the standard price, okay, and standard cost allowed would be the standard quantity allowed. That is the standard quantity for the actual volume. Okay, because remember this is a flexible budget times the standard price, and we'll have to practice this so you can see it, but we'll do problems in class. And the way that I remember this, like especially if I get nervous, is if you start out here with AP and think AP dollar sign, okay, so actual price times actual quantity, repeat the actual quantity term, actual quantity times standard price, repeat standard price times standard quantity. So over here we're all actual, and on this side we're all standard. Okay, but remember it's a standard quantity allowed for actual usage. Okay, and then if I subtract these formulas from each other, this becomes actual quantity, all right, take out the common term, times the difference in price, and that makes sense because it's price variance. Over here I've got my flexible minus my standard, so standard price times the difference in quantity, and this is quantity or efficiency variance it's called. All right, so this is what this is the formula that we end up with here: actual quantity times the difference in price, standard price times the difference in quantity, and this is for total direct material variance. But there are a couple things that are different here. All right, the direct material price variance is based on, this is how much of the variance is due to paying a higher or lower price than expected for material purchased, okay, for what's been purchased. Whereas direct material quantity variance, how much of the variance is due to using a larger or smaller quantity of direct material than expected of using. So this is what's been used. So this is based on what's purchased, okay? Direct material quantity variance is based on what's used. And here's an example, the Tucson tortillas, right? They've got number of cases produced, so 31,000, and then they give you material purchased, 160,000 pounds, material used, 160,000 pounds. So in this case, it's the same number, okay? It won't show you the differences. And here is the difference here. My actual cost, $224. Flexible would have been $240. All right, so I've got a huge $16,000 favorable variance. And if I look at my flexible minus my standard quantities, then I've got an unfavorable variance. Okay, so our price may have been really good, but we used a lot more, so maybe these materials were cheap. All right, and the total variance, what you would look at is the difference between actual cost and standard cost. And the only reason why they sum properly right here is because the amount purchased is the same as the amount used. Okay. So here is you would talk to your purchasing supervisor and find out what the 16,000, why it was so good. Was the standard off, or was there a major change in the prices of one of the inputs? Now here's a good summary page for direct material variances. This is one of the special things in variances, okay? It has to do with material variances. The direct material price variance is based on the quantity purchased. Okay, the direct material quantity variance will be based on the quantity used. So standard price times the difference between the actual quantity used and the standard quantity used, okay, for the actual number of units. That's the part that you have to remember there. So direct material price and quantity variances will no longer sum or net to the total flexible budget variance because they're going to be based on two different quantities. And the reason why is because if you want to evaluate purchasing, you want to evaluate them in terms of like the whole load of maybe a part or whatever they purchased. It should almost be based on the tractor load. Okay, not on smaller amounts, because you get so much, you can save so much money in freight by purchasing that way. Okay, now here's an example when the quantity purchased differs from the quantity used. Here's my price variance, 52.50. My quantity variance of favorable. My quantity variance is 3,000 favorable. All right, and notice how we've got the direct materials purchased. So this would be for price variance. Materials used would be for usage variance. Usage or efficiency. So let's look at some direct labor variance, and these are pretty much the same formula. Okay, only what we're looking at is the difference in rate versus the the total number of hours they used. Okay, so you either paid a group of workers more or less than you planned, or it took them longer or a shorter time than what you planned. And here's an example. Tucson actually used 1,500 hours of direct labor. Its standard rate was $22 per hour. So this is rate variance. So rather than having prices here, we've got rates. So actual hours times the difference in rates. My actual hours are 1,500. Here's my difference in rates. The planned, the rate that they used it at is greater than the amount that was planned, so it's unfavorable. All right, remember, you're not going to look at plus minuses here. You just reason it out. It's really your best bet. Efficiency variance, they produced 31,000. Its standard rate was 22 per hour. The standard number of hours was 0.05 times the hours times 0.05 hours of direct labor per case. Okay, and notice right there for the standard, we're using the actual number of cases produced, the 30,000. Okay, so 22 times 1,500 minus 31,000, the actual cases, times 0.05. Okay, and I've got 1,100 favorable variance. Okay, and here again is the way I look at it. I start out with actual rate. If I write this down, I can do any variance problem ever and never goof it up. Okay, and you can look at this in the book. It's the same thing, but what it comes down to is actual hours times the difference in rates, and this is standard rate times the difference in hours. And here is we're looking at actual costs and a flexible budget, okay? And we're taking it apart into rate variance and efficiency variance. And the direct labor variances don't have any other fancy things going on, okay? It is what you expect it to be. And then this page summarizes the variances, and you know, this is the kind of thing that does not go into my head. Maybe it does you, and maybe this is a good chart for you to use, so that's fine. The only thing that's good here to me is who to talk to about the variances. If it's direct materials, you talk to purchasing. If it's usage, okay, how much a quantity variance, you talk to production. For direct labor and rate variances, human resources and production supervisors. And for efficiency, again, the production supervisor. Okay, like who would have information that you could use to explain it? Now a little bit on the advantages and disadvantages. What's good about it, the most important good thing, these are cost benchmarks that we can use. Okay, if you did a good job developing the numbers, then that's a good number that you can compare to what your actual results are. It's useful in budgeting and in bookkeeping. All right, especially from an accounting perspective, it really makes it clean. And it can be motivating for employees that this is the number that you're working toward. Okay. Disadvantages, they might be inaccurate. Okay, you've constantly got to update these for any changes in the market or changes in your process. Sometimes that means it wouldn't be timely. A focus on operational performance measures and visual management. Okay, a lot of people prefer to look at different measures to see what's really happening on the floor, because the financial numbers can get really wacky, you know, and you can spend a lot of time looking at these where some operational measures might be a faster way toward your end. This is lean thinking. Lean thinking doesn't go into all of this detail. Okay, increase in automation. We've got a lot more automation, so direct labor basically doesn't count anymore. I think Harley-Davidson doesn't even track direct labor. Isn't that something? And then finally, unintended behavioral consequences, that people's behavior will actually change once they know the standard. So the last thing we've got here is the variable and fixed overhead variances.